Hey there, Cody Rogers, WMX Advisors. Let's get a quick outlook for September. Okay, U.S. domestic markets, bear rally, continuation of a bull run, let's say from June 15th through August. We had a bumpy August, didn't we? So now what do we look forward to? What's September going to look like? What's quarter four going to look like more specifically? Okay, so we are pushing and pulling. We have this massive tug of war right now between our bulls and our bears. Behind the bulls, what do we have? We have massive amounts of cash, okay? We've got capital. There's more than $6 trillion just waiting on the sidelines to be invested. So the bulls are pushing. They're pushing. The market goes down. The bulls see it as a buying opportunity. What do the bears have? Well, the bears have fundamental analysis, right? The Fed keeps saying, hey, we're going to raise rates. It's going to cause pain. We're going to inflict pain on the United States economy, on the U.S. economy. And in doing so, we're going to reduce earnings. We're going to reduce the opportunity for work. We're going to reduce wage growth. And all of those things will reduce inflation, hypothetically, okay? So we've been here before and it's worked in the past. Let's see if it works now. But why do we see that there's this push-pull, and why don't we know what's technically happening in the market? Well, it's because we've been through it before. Investors see this as an opportunity to get involved in the market because what do we do in the market? Well, we earn money. Okay, so these bulls, they continue to capitalize on a lower stock price of their favorite companies. You know, you see a lot of tech companies. They're currently underweight. Their earnings pressure, their price to earnings ratios are down, but they're still too high. And the reason being, let me explain this to you. Basic economics 101. We focus on the cost of capital. Okay, so as the federal government raises rates, it costs more for businesses to be productive, for them to hire, for them to move money into employees' pockets. So what do? They start to cut back, or they work on efficiency. That cost of capital is the focus here. But it's also what we call a risk premium. In equity investing, there is a point to where I'd rather not take a risk. For my clients specifically, you know, if we get to the point where a yield on a bond is paying 4 to 5%, that's all some of my retirees need. They won't be in the market. They'll be out of the market, and their money goes with them, and they'll receive their yield and not take any risk because, you know, these bonds are backed by the federal government or corporations that have strong balance sheets. So if the federal government continues to raise rates, you'll see that there is a decline in market values. And that is one of the challenges with the bull perspective, is that if you're looking to buy at lows, are we at lows? The rates aren't high enough for me to take money out of my client's portfolio. Ultimately, if we don't control inflation, if we don't control earnings growth, and we have this price fluctuation that continues to push prices higher and higher, then the federal government's going to have no choice but to continue to raise rates higher and higher. Now, one of the challenges in the 1980s is they dealt with inflation, but they dealt with it very slowly. Okay, so they started raising rates slowly and they were trying to adjust. It didn't work. They actually had 2 recessions back to back because they thought they fixed it. They reduced rates. The inflation came back, and then they just hammered rates. They hammered rates, right? In doing so, Paul Volcker, you'll hear that name from the news stations, but in doing so, what that did is that caused a steep economic recession. No more buying. So why is consumer confidence, why is consumer spending still going? As consumers, we've gone through savings, and now we're looking to use our credit because we have great credit, because we've gone through a decade to 15 years of a bull market, and we've worked hard to earn assets and balance sheets, and so we've applied for credit, home equities, credit cards. You know, you've got your auto loans, but we've got those student loans on the back end. So we've got this credit. And then it translates to spending power or purchasing power. And we as U.S. consumers, recently we've dealt with an economic crisis of our own, and that came through COVID, right? COVID caused a problem. So what happened during COVID? Well, the United States government bailed us out. One of the challenges that I'm going to find here is that we as the U.S. consumer, does that create an expectation, right? Do we feel like moving forward, if times get tough, well, we've got Big Brother, the United States federal government's going to bail me out. So we're focused on spending, and we continue to spend. We have an addiction to spending. And one of the challenges with that, credit is going to run out eventually. And when credit runs out, do we continue to spend? Do we charge off those cards? Do we run away from our debt? Do we hope Big Brother pays those debts off? So we're entering the market with our cash. We're still seeing declines, so we're losing that purchasing power, which is what the federal government's looking for. They're looking to draw money out of the cycle. They're looking for us as U.S. consumers, terrible as it is, to lose money so that we have to cut back our spending. When we cut back our spending, supply grows, and in turn, inflation is reduced. But if we don't, they're going to keep raising rates. As it looks right now, the historical view is if inflation is stubborn, then we are going to be in for some pain quarter 1, 2023. One of the things that I cannot stand, and it's my profession, it's wholly my profession, is that analysts, advisors, I get all these people on TV all the time, and they're the CEO of their, Smith investment firm. I'm John Smith, and I think I know a lot. Well, John Smith gets on TV and he says, you buy now, you buy. It's important to buy. Why is it important to buy? Well, for John Smith, it's important to say those things because John Smith, he's getting paid money by having people invest. If they don't invest, does John Smith continue to make money? He doesn't. He is an eternal optimist. by design. I have to be, because I have to look not just the interests of my client, my fiduciary responsibility, but the interests of myself. And in my profession, if I have no one interested in investing because I'm spouting a view that is not optimistic, that's not saying, hey, we're cyclical, we can go into commodities, we can go into this, we can go into that. If I'm not saying those things, then I'm bearish. And if I'm bearish, I'm a terrible advisor, right? Well, I don't believe that's the case. I think that an advisor should be honest. And with regard to the market cycle right now, there is going to be a lot of pain experienced Q4, Q1, Q2 of 2023, simply because the consumer is going to eventually run out of capital to spend. Wages are growing, but if we continue this cycle, businesses start to cut back on employees. We have nothing to look forward to except for economic pain. And when economic pain comes, who is going to be there to help us? So just a quick question for September, who is going to be there? Is Big Brother going to save the day again? If there's any questions, of course, feel free to reach out to me. Comment below, like, subscribe, I don't even know. But Cody Rogers here, WMX Advisors, happy to visit.
Would you be mine? Could you be mine? Won't you be my neighbor? Won't you please? Won't you please? Please won't you be my neighbor? My neighbor.